Did Fed Chair Powell just let the bond bears out? Hi, everyone. Welcome to the Real Vision Daily Briefing. With me today is Greg Weldon, the CEO of Weldon Financial. Hi, Greg.
How you doing, Maggie?
I'm doing okay. Doing okay. A little tough to watch the equity markets today. I mean, we knew that there was a potential for Fed Chairman Jay Powell to make some news. He testified in front of Congress and came out right away and warned that they may have to do more to try to bring down inflation. Does that mean a bigger rate hike in March? What are you expecting?
Well, I don't necessarily think it means a bigger rate hike in March. If you listen to some of the sideline Fed comments, it's pretty much been, we probably time to be a little bit more cautious. It's been a little bit of a yellow light flashing, not quite. Powell has to, of course, carry the torch of vigilance on inflation. Powell hasn't said anything different. Powell has said the same thing continuously. I think what people with Jerome Powell is he said what he's going to do and he did it, even to the degree that he let inflation go above average and stay there with no range of tolerance and all the things he talked about in 2018 about getting inflation up. He did it exactly what he said. Let's let inflation run, and it ran. The pandemic caused it to run maybe a little too hot even for the Fed and Powell. But Powell is a student of the 70s. Volcker is his hero. He has said this repeatedly since his very first Jackson Hole speech, that we have the Volcker playbook. And I did a piece recently where we went back and looked at testimony, this testimony we have right now, Paul Volcker in 1978. Fascinating stuff. It's almost like Back to the Future type of thing, right? And Powell is playing from that playbook. He's using the same verbiage, and it's pain. They're basically saying, look, we can address a recession with rate cuts down the road. Thank God they got ammo back. That's a really good thing that people don't talk about. Doesn't have to go right to QE. You can actually cut rates. But I think the degree to where you don't have disinflation and it makes it tough for Powell with inflation where it is. Well, it drops if the base effect kicks in. Maybe it won't with energy. But where Powell doesn't see disinflation in the markets. Difficult to say we're done tightening. We've beaten inflation when the stock market's almost at new highs and gold's almost at $2,000, and the dollar's been down since August.
Yeah, it's those conditions sort of moved against them for sure. We saw, and you're right. They've been. I mean, if you sort of sift through the tea leaves, maybe a little bit the verbiage has been. I mean, but really, it is the same message that we are on this, in this fight. But you saw the markets did react today. We saw this off in equities, but really the 2-year Treasury yield now rose to 5%, highest since 2007. How are you feeling about bonds here?
Well, see, good point on the 2-year. The problem with that is the 2-year Fed funds forward is still like below 4.5.
Yeah.
So you also have the dynamic around, they have said consistently and said again today, the last 3 paragraphs of a prepared testimony was everything he's been saying and probably as well as he said it this entire time, right? Verbatim, 3 paragraphs. And the end was, look, we have to be tighter and then be restrictive for a longer period of time, right? The market's not pricing in. The market is pricing we're going to get to the terminal rate and then we'll be lower in the future. And pretty quickly, as quickly as the second half of next year, which is a bit of a shift because it had been the first half of next year when they would be easing already into a recession. So that's been pushed back to the second half, but I still don't think that's enough for the Fed to feel comfortable in taking their foot off the brake. They've also said repeatedly, it's more of an error here to stop too soon than to go too far.
Yeah, so it sounds like, and we see the 10-year hanging below 4%. I'm pretty sure it closed there. So do you think that bond investors are mispricing the situation?
Well, that's a good question and a hard one to answer. I don't think necessarily, okay? Because I think when you're looking at the bond market, it's pricing in the economic damage that's being done. So to whatever degree, I actually have a flip scenario here. And it's kind of like the flip scenario when the Fed was trying to get inflation for so long and they couldn't get it. And they used to use waiting for Godot. You're waiting for the guy that never shows up. Inflation was Godot. He never showed up. And then you know, the alternative ending in 2019 where Godot shows up. And that's what happened. Godot showed up. Inflation came. So in this case, it's almost like you look at the equity market. Does the pain come when bond yields actually kind of fall, or at least at the short end, all right? Because in that case, real short interest rates will be rising, even because you're going to have inflation falling faster. I mean, I think it could be a case where when you kind of have reached a point where you think the Fed might pivot, then some of the pain comes in the stock market. And people are kind of looking around like, this doesn't make sense. Why is this happening? And it's because you're understanding that credit is going to be harder to get. The consumer is choking. Inflation has caused a lot of heartache. Savings are down. People are borrowing like crazy. Consumer credit's through the roof. It's record after record, 20 billion a month after 20 billion a month. We never saw that twice in a row. Now we got like 7 out of the last 9 months or something like that. And at the highest cost of money that we've seen since 1980. People are borrowing like crazy to pay the bills at 20% on credit cards. It's not sustainable. So I think when the turn comes, it could be interesting when you kind of pull back the curtain on the economy, and that's when the stock market reacts negatively.
Yeah.
But I think the Fed wants to wait to see some of that first before they feel comfortable taking their foot off the brake, and that's kind of a problem. It's a conundrum almost for the market.
It is, and we felt like we were getting there a couple times, and then as you mentioned, then we see that turn, and we see financial conditions loosen a little bit. So what do you do? What do you do in this environment if you're looking at bonds? Are you sitting in cash? Do you want to stay super short duration? How do you approach this kind of scenario?
You approach it like fixed income has become income again for the time being. So, I don't look at bonds as a trade right now, or, if you wanted to invest some money into bonds, I don't have a problem with that. I just think, inflation will eat it up over the long haul anyway. I think this is a turn in a 40-year trend, lower lows in inflation, lower lows in interest rates. And you hit the denouement point where it kind of doesn't almost matter how much money you print, because exponentially you have to keep printing more every time. And you've gotten to the point where you have angles of ascent of balance sheets, and even the stock market, when they print money, are straight up and down. It's almost like geometrically, this can't continue in that vein. So I think there are problems in that sense going forward where I don't necessarily want to own bonds. I mean, I am one of those who feels like you've shifted to a point where even stocks could, come down, then rally big, suck everyone back in when the Fed kind of changes the narrative, and then just go sideways, because where's the growth, right? You don't need the growth just to pay down the debt too. Let's not forget that. That's a big problem coming out of this, right? Is the growth going to be good enough to handle the debt that we have created here? So there's a lot of question marks there. And I think that, those will ultimately be answered. I think this is a time to be nimble, where you can be in and out of things. I think you need currency exposure. I think you need exposure to commodities. I think it's a broader type of investment, dynamic now, environment, where you have to take advantage of other things just in looking for the ultimate place to buy stocks, because it may not turn out to be that great a buying opportunity.
Yeah, Greg, you pretty much just described a series that we've just launched this week, which are looking at some of these big, like major time bombs and threats that we all worry about, and then how to be nimble and maybe navigate and find some solutions around that. So we're with you. We feel that. We're going to hear from somebody in that series in just a moment. I want to ask you about something. One of the things that when you sent some notes over, there was TBT. What are you looking at that, and what is that? Is that something you see as a way to play this? Because that doesn't come up as often.
No, it doesn't. I mean, when the ETFs were first introduced, I was really excited. And then when the short ETFs came out, I was really excited because I could take the CTA approach that I have and transfer it to people that trade equity. Problem is, they don't track well. There's all kinds of issues with dividends and tax treatments, and everyone's different. And oh my God, liquidity. So from the point of the TBT, I'm away from it now. I mean, that's something that could have been used in 2021, beginning when, honestly, when the Fed funds forwards were at 80 basis points and the 2-year note was still at 20 basis points. One of the greatest tells ever. I mean, that was unbelievable opportunity. So in that case, some of the short bond ETFs worked. One of the things I've looked at is the TLT, which is the 10-year Treasury, the long side of that trade, against the S&P. And the S&P is almost like it's hanging around a new record high against bonds too. What if you suddenly get this rally in bonds that kind of sucks money out of stocks? And so that might be another way we could see the pain start to develop in kind of a disinflationary environment if we ever get there.
So is the soft landing scenario off the table?
I think so. I mean, and I only say it in the sense of the probabilities. And I've done a lot of work on this. All right. And I've called it, since spring has sprung and spring training is all around the place. I can ride my bike to 3 different parks down here. It's great.
Benefits of Florida.
Yes. 3 strikes and you're out is the piece I did recently. Right. And it actually goes back because this is, a little bit, a couple months old, the theme, because it's existed for a couple of months. And this is, if you get these 3 things happening at the same time, it's been a 100% chance of recession. Number 1 is food at home on CPI above 6% year over year. got to 13, still double digits. All right, so it's way over that. The second one is the yield curve inverted, 30-year, 2-year. Most inverted since the 80s, and it's been that way for a while. It's all of a sudden kind of making pop media headlines, and it's been that way for a while. If you look at the bell bar, some of the different ways of looking at the yield curve. And third is the U.S. dollar up 20% over a 52-week period. You had that in May and in August, and even more than that, it's almost like you're called out. It's a called third strike in the sense that 30% up in the dollar versus gold is like the kicker. Those four things, you don't avoid a recession and haven't in the past. So that sets up for recession 12 to 18 months from a couple months ago. Then I would say all the focus here is on the U.S. and the Fed, and like the Fed can just ride the white horse in here and kind of save the U.S. economy. When we look at other places in the world where food inflation is 35%, where the currency's down by half in terms of purchasing power, wow, those places are really choking. And I feel that you have a situation where it's more of a global recession threat than just the U.S. And beyond that, of course, the geopolitical risk, it's spring. We know history. If something's going to kind of pop off here, this is kind of the time frame too. And the last thing the Fed needs is something happening where energy prices spike and remove that base effect that could have been driving inflation down the next 2 or 3 months. So yeah, there's a lot going on.
Oh my goodness. And that's a fantastic summary of the stuff keeping us all up at night. I feel like you have been participating in our series. I mean, this is exactly what we were talking about, is all the risks out there. And I just finished taping with 𝗗𝗔𝗬𝗦 earlier today too. So we're going to have a lot to say about the geopolitical risks out there. But it's interesting because timing all this has been so difficult. Raul set the scene in our series the first day. And today, Roger has an interview out with Dario Perkins releasing where he's talking about some of these fundamental changes. And you touched on a couple, but fundamental changes that we need to recognize. Let's have a listen to that clip.
Yeah, I mean, there's been a huge amount of noise. So we've been living in this sort of artificial fake business cycle. For the last 3 years, investors have, keep sending me emails saying, where are we in the cycle? And I keep saying to them, this ain't a business cycle. This is just not a normal cycle. It was driven by lockdowns and then sort of big rotations in the way people were spending, in behavior. None of this was a normal economic cycle. And then just as we were emerging from that, we had the war with Ukraine, in Ukraine. So, it's caused these massive distortions in the economy. It pushed inflation to very, very high levels. I don't think anyone is talking about sort of persistent inflation at sort of 8, 10, 12%. So all of that stuff is going to unwind. But I think that when you look through that, you're going to say, well, what's fundamentally changed over the last 3 years? So I think one is that we have, massive labor shortages that we didn't have before. Those naturally tilt the balance of power back towards labor. And we see that very clearly with wage trends, particularly in some sectors where older workers have dropped out of the labor force, you're getting these big increases in wages. The second one is globalization. Already we were beginning to see this sort of fragmentation of global supply chains. That's really been accelerated. Firstly, you have this sort of private incentive to do that because these supply chains have proved to be incredibly vulnerable, when stressed. And then you've had these big geopolitical shifts that sort of accelerated after Ukraine. So you have this move towards friendshoring and reshoring and a completely different role for governments in the economy. And so all of this sort of tilts the balance of power back towards labor again.
That full interview, along with the series, is on our website. So just scan the QR code to access. Greg, when we're looking at this, and I'm always really interested in this we've been throwing that term around, the deglobalization, the supply chain situations. Peter and I talked a lot about that. I think it's going to come up a lot, especially this first week when we're talking about the challenges and these big looming threats to our future. But when we're looking at this situation, are you expecting inflation to remain elevated? Are you in that camp?
Yeah, I mean, yes, I think that you will see inflation ebb and flow. You will see inflation come down. At some point, it will come down hard. It's a mathematical inevitability. But I think the main point to be made here is you have reversed the 40-year trend. Down in interest rates, down in inflation. It is now higher highs and higher lows. So yeah, it'll come down and it'll base somewhere at a higher level. It's interesting to look at something like Japanese CPI. Interesting to look at because all of a sudden this had taken off, in the index itself. And it's gotten to a point where it's actually really moved higher as an index, not necessarily year over year, and only got to a high of like 4.5. But when the index is really moving, and then you look at what a correction is going to be, and you see for that thing to come down like a 50% correction of the move already, you're talking about a pretty significant near-term deflation. So you could have deflation periods within the context of a secular trend higher in inflation overall. And I absolutely believe that if for no other reason than the next recession, the next downturn in the economy, which is lurking out there, they're going to do the same thing, which is debase the purchasing power of money, print more money. And this is what you have. And I mean, this is why this has changed. All right. You've gotten away with it for so long into QE in 2007, 8, 9, 10, 11 through 2013 when they finally did, tap out and then taper, tap out and then shrink it.
Yeah.
So again, it's just print more money, the same reaction, debase the purchasing power of people's money. And that's why it's going to be more difficult to keep up. And I just think buying stocks and holding stocks, hey, the Argentinian Merval makes new highs every year. It doesn't mean the standard of living in Argentina is going up.
And this is we're hearing over and over again is it's not what it was before. There's some uncertainty about what it is and what it's turning into, but everyone is saying what worked before will not work. There seems to be a lot of agreement among the people who come on Real Vision that that's the case, which makes it a really tricky environment. Want to pull it back a little sort of closer to the here and now. And we talked about the Fed. Let's talk about the ECB. You had some, and Brian will put in the chat for everyone where to find all Greg's stuff, some fantastic stats and charts, just really digging into the inflation situation. And you seem concerned that the ECB is really behind the curve.
No, they are. I mean, there's no doubt about that. You have some pullback in inflation numbers. All right. I mean, Italy, for example, you come down. It's like, wow, we came down to like 9%. Wow. And it's still minus 600 basis points for a real policy rate in Italy and in other places like on Eastern Europe, where Latvia, Lithuania, some of these countries I talk about that no one really cares about, but I'm telling you, they lead the way. Their data is first, up and down. So that's why I watch it. And it doesn't bode well. And even in a place like, you had, Italian inflation came down, which was great, but the core rate rose to 6.4 from 6%. It was a new high. So the other problem with that is you have some base effect that, is coming. It's been muted by the recent rally in energy and could be muted further, but that's been offset by food. Food inflation is sticky. When you look at the CPI in the US, it's 139, I think. I usually break them down one by one. 139 different components of food inflation. All right, so getting a seasonal effect on that, getting a base effect on that is very difficult because there's so many different things. And I think that this is something where you talk about supply chains, where you talk about the stickiness of inflation, you talk about incrementally higher cost every step of the way. Food inflation is here to stay, and that's a problem for central banks. And, again, so I mean, the ECB is very far behind the curve. You also have money supply shrinking. M1 is now deflating. You see kind of the same thing in the US. Money is shrinking at a time when the cost of everything's still going up. So, this is a problem longer term in terms of the economy. And the further behind they are in the curve, the more problem it is in the economy when their inflation does come down, assuming that, it comes down and stays down for any length of time, which is not a certain.
Yeah, I want to, we have a chart. I'm going to tackle two things here. We have a chart of DBA. So this has been interesting because this sense of food inflation, and a lot of people were anticipating, they were trading in DBA with the idea of this scarcity of supply, and you saw prices come off. But now obviously we had that big drop, and now we're kind of bouncing around here. Does the fact that there's food inflation and food supply and scarcity, does that mean you should be investing in food commodities though, or would you be worried about that? Is there not that translation?
I like the sector a lot, first of all, and we caught the first wave up in the DBA. I mean, with the DBA, you have to understand the components, and then you have to understand how individual these commodities are. I mean, soybeans have nothing to do with sugar. So you're not necessarily talking about correlated assets in this, in this ETF. I prefer, this is why I love the individual ETFs, like cane for sugar is a good one, or SOYB for soybean. There's a whole host of them, right? And that's the stuff that we put out every day, how to be active in these markets. And I think you're in a situation where the margin of error is a bullish outcome. All right. we've had some actually negative news, especially even in the soybean crop, where you've had big crops in South America. Brazil is going to produce a record crop. They just revised it too, and it was like an 18% 1 month revision. It's really kind of nuts. And they're going to be exporting a lot, so it's going to be competitive for the U.S. And I tell you, soybeans came down because when you look at the balance sheet at a price like this, given all the money they printed, given the price action, given the technicals, you throw all this stuff in, and it's like soybeans are kind of fairly priced here in an environment that's not necessarily bullish. Well, if it gets bullish, you have no margin for error in these things. That's, for me, the problem. It's not so much they're all bullish right here. Some of them are. Sugar really is. A couple of them are. Not all of them are. But the margin, look at orange juice, for example. I mean, this is something I've been talking about for 2 years, just because it's here in Florida, and I've seen the decline in the citrus crop. And all of a sudden, it's like one day it turns into news where everyone's shocked that the orange crop's down 30%. Where's Beeks? What happened to Beeks? You know, and it's a shocking move in orange juice since, $2.80 a gallon. So I think you're going to see more of those incidents in the food commodities. I think they're worth playing. Sometimes it's tough with the DBA because it's a little bit mixed.
Yeah, and that's a great point. And that's with every ETF that you're looking at. You really need to understand the underlying in that before you make a decision whether you're better to go individual. So it's always great to bring that up. Would you be investing in Europe, given the fact that the ECB is so behind in some of these inflation reads that you're talking about and some of the trouble? Because a lot of people at the beginning of the year were like, oh, now there are alternatives outside the US and Europe's been dead forever. It looks pretty good.
And even European banks, right? I mean, European banks didn't look so bad there at first either. It's a good question. I don't know. I mean, I just don't know. I mean, technically, these markets look really good. And if you take some of the ones that have underperformed and haven't made new highs, like the DAX has, or, specifically Italy and Spain, the IBEX and the MIB, technically, they look like they're breaking out on a long-term basis and have some catch-up to do, and they don't look so bad. I can't find a fundamental justification for that, Paul. I just can't. It's more of a relative play for me because it just scares me. But technically, it looks good. Fundamentally, I just wouldn't want to go anywhere near it. I mean, let's not forget, we're talking about countries with huge debt. Belgium, for example. I mean, Belgian inflation's come down, and their interest rate relative to the ECB, the ECB's policy rate, is actually about -300. All right, if they're in a recession, that's a perfectly acceptable level. But bond yields are breaking out, despite the fact the economy is rolling over, because it has to stick with Germany, it has to stick with Italy, it has to stick with everybody. So it's one of those cases where Belgium, on a per capita basis, almost as bad as Italy in terms of debt. So you can't forget the sovereign debt issue, which I think could be an implosion anytime. And you talk about, you said it perfectly. I use the phrase all the time. There are so many landmines out there. Thinking we're going to cross the field without stepping on one is kind of almost narrow-minded. And the European markets don't look bad. I don't see the fundamental justification, and the risk scares the hell out of me.
Yeah, I think that's really well put. And that's a difference. So know your time perspective, because if you're going to be super nimble and you're somebody who is more technically driven, that's where we've been getting a lot of the comments, I think, on the price action alone. But, you need a full framework. I think if you're going to look at that and really understand your risk.
It's just better places to put your money at work. Some of these commodities, some of these currencies, I mean, some of these currencies are going to look really good when the Fed does turn and the dollar comes off. And the dollar's come off a lot already. If you look at the dollar relative to gold against the Fed funds, you take that as a measure of monetary conditions, it's basically saying the Fed funds rate's closer to 2.5 right now, in terms of monetary conditions have loosened because the dollar's come off. So I think that currency market, commodities markets have a lot of great opportunities. I don't need to bang my head against the wall with European stock index.
Is there a currency that you like here? Because there's also a lot in play here, isn't it? We got the BOJ coming up. We have a lot of stuff on the radar. BOJ later in the spring, but also some stuff happening Friday.
Yeah.
Is there a particular currency that you like?
I'm writing right now about the BOJ for tomorrow's live, actually, with their inflation numbers and their employment numbers. Bad. I actually have liked and continue to like the Mexican peso. And then I start to want to look at some of these kind of offhand current commodity currencies, like the Brazilian real. So those are two that have caught my eye, and we're in both right now, and so far so good. So we'll see how that plays out. And that's in a period where the dollar has either been sideways or up in terms of the dollar index. So that's pretty phenomenal relative performance.
And is this sort of tied to your bullish view on commodities? Yes. Do they go hand in hand, the currencies and commodities?
Absolutely. But you also have to see that currencies like the Canadian dollar and the Australian dollar done poorly. I mean, they had a couple of false breakouts. I mean, it was like a bull trap and, got whacked, and they look more like they're going to break down. And that's also, we were talking about this before, everything polarized. I mean, you can have the commodity currencies like the Mexican peso and the Brazilian real and the South African rand even that go up. You can have other commodity currencies that go down because they're maybe more susceptible to the recession side, the demand side. Some of the commodities can weather that, like copper, just because there isn't enough copper around. Some of those commodities can't. So we'll see how this happens. And you could have a situation too, where you have kind of commodities coming down on a recession view, but oil going up on a geopolitical dynamic. Now, wouldn't that put a, throw a monkey wrench into the Fed's machine?
Yeah, no, you're exactly right. Exactly right. And when you're talking about currencies, I'm always reminded of Weston Nakamura, who's always, when you ask about the dollar, he's like, what cross? Like, it's not a basket. Like, what? You can't think about it like that. And sort of hammered that into us. We've got a couple of questions. I want to get to them a little bit all over the place. So if you're looking at this particular area, great. If you're not, just punt it back to me and we'll move on. 𝗗𝗏𝗦 asking, can the yield curve steepen by the long end rising?
It could. I mean, you also have one of these things in the U.S. that people tend to forget that is, omnipresent, which is public borrowing and deficits and debt. 30 plus trillion and running. You 2 trillion public borrowing a year as if it's nothing now. I mean, the numbers, people have become so immune to these numbers, they don't really fully understand the size. What I think is going to be needed next in terms of how much money you have to print next time. It's going to be exponentially more. 4 trillion the first time, 8 trillion this time. It's going to be 12 to 15 trillion. Will the political will or the stomach be there to do that? I don't know. But in terms of what was the question again?
Yeah, he said, could the yield curve steepen by the long end rising?
It could. I mean, if the Fed could lose control of the bond market. Any of these central banks could. We've already seen episodes in the UK and Japan where it's tenuous, all right. And with the debt and with the spending, and look at tax revenue. If the labor market's so strong and everything's so great, why is tax revenue, individual tax receipts, down 9% year over year? I mean, that's pretty interesting to me. So you start to talk about things like that and the deficits, and yes, absolutely, I could see a case where the yield curve could steepen with yields going up at the long end, and maybe even yields coming down. Let's put a case where the Fed turns too early. And they're going to now really deal with the economy, the recession. You got jobs now being deflated, right? So the Fed turns, yet inflation is still 4.5%, 5%. The bond yields aren't going to like that. You can see the curve steepen that way too.
Yeah, losing control of the bond market is a really interesting thought. And I'm going to guess that 𝗗𝗏𝗦 is thinking about the BOJ when he's asking that question. Colin asking, is the best solution for a real slowdown in China to bring global demand down rather than using rates?
Well, I mean, that's a really good and loaded question. We could talk for a half hour on that alone. I mean, you know my view on China, which I'm sometimes reluctant to discuss because it's kind of almost too sinister to want to think about, right? I mean, you're talking about now the U.S. kind of warned China not to give weapons to Russia. It's like, hello, McFly. I mean, do we not remember the Olympics? Do you remember Putin and Xi sitting down and a 30 trillion renminbi new deal for a new pipeline from Siberia for crude oil, and they're going to engage Kazakhstan to ship natural gas to China? All that money is lent by Chinese state banks in renminbi. The crude oil will be priced based on the Dubai price and the Shanghai Futures Exchange, denominated in renminbi. When the Chinese Communist plenary session just ended, Xi came out and he said the number one thing, the Communist Party, food security. Why do you think Russia's in the Ukraine? All right, this is about shipping food to China. You got ports, you got food. This is a tag team. You throw OPEC into the mix. After Biden dissed, the younger faction of the House of Saud, and they're the people that run Saudi Aramco, and they shifted barrels to China from the U.S. in the very first month that Biden was president. Don't think that OPEC and Saudi Arabia are necessarily on our side here either. All right, more deals going on with China there as well, even to the degree that they kind of have Iran and Saudi Arabia talking at some level too. I mean, that's an accomplishment unto itself.
Yeah.
I don't think that they're not going to make a move on Taiwan either. And that's when the U.S. gets involved. They threaten to drop the dollar petroleum card currency, and the U.S. backs off.
You're right. We're gonna have to take that whole answer, and we're gonna have another conversation about that because there's a lot in there. We're some of them are coming up in my conversation. Some of those threads we touched on in my conversation with Peter. That's gonna be out Thursday, guys. We are out of time. I gotta ask this one question though. because it's so funny. I haven't heard anyone talk about this. Joseph, thank you for that. Would tobacco stocks be part of your commodity thesis? I haven't had anyone ask about tobacco stocks in I can't even remember. Thank you, Joseph, for that.
I don't know any of the statistics on tobacco growing. None.
Yeah.
Don't follow
Okay.
it. Because there's no futures market. So, I can't really
Yeah.
say.
Yeah. It's such an
No idea. Sorry.
Yeah. Somebody's going to be watching that, Joseph. We'll find out if they are.
Somebody knows, clearly.
Somebody knows, right? There's some. You know what? We'll take that up on one of our other shows because that's a really interesting one. So there are fantastic questions. I'm going to squeeze one more in. Best way to invest in commodities. ETFs? Question mark. I think Richard came in a little late to this conversation, but not always.
I think ETFs, but I have to say, I think, and I don't say this because I am one, Series 3 registered commodity trading advisor. People that do what I do are going to go up in value. They did in the 70s. It's a very similar situation. We can be long or short bonds. That's going to be huge. We can be long or short stock indexes in any country. It's going to be huge. Be long or short any currency. It's going to be huge. We get the industrial metals, the precious metals, all the energy. And all the ags, and we can be nimble, we can be quick. It's liquid, it's cash turnaround. The problem with futures is that people don't understand how much money you need to actually trade them. Right? Yeah. Very undercapitalized is the biggest problem for most people that trade it themselves, because a gold contract at $2,000, one gold contract's worth 200 grand. So you can't trade it putting up 50 grand anymore in the futures market. You kind of need a professional who, has a track record and has been doing it for a long time. Anyone. Honestly, and I'm kind of selling myself, but not to sell myself, because I'm positioned to do this because I've seen these ups and downs in inflation. I came into the business on the trading floor of the commodities exchange in the World Trade Center in 1983. And I got out of gold because I saw it was a dying breed, and I started trading currencies for Lehman Brothers. So I've been doing this a long time, and people that do what we do and can be flexible and take advantage of all these opportunities, which are going to be phenomenal. A lot of bad things are going to happen, but the opportunities that come of it are going to be outstanding and kind of some wealth creation opportunities, just like in the 70s.
Yeah. And that's a great way to end it, because I think that's true. And what we keep hearing from people. You have to be nimble. You have to think differently. There's going to be dispersion. There's going to be volatility. It's not just sort of, take your pick and sort of walk away and set and forget. We're not in that environment anymore. Greg,
this is dead. We can declare it officially dead.
That's right. This went by like that. There's so much good stuff we were talking about, and so many great questions. But we'll have you back again soon. It's always great.
People can email me the questions. Find us on the website, so I'm happy to answer.
That's awesome. And Brian dropped some information in the chats on where you can find Greg for any follow-up or any further discussion, which is fantastic. We'll be back same time tomorrow with Doomberg, and don't forget to check our special series about how to navigate the massive risks out there. Here's a little bit more on how you can unfuck your future.
If we want to change the outcomes for this really screwed up world, where our wages don't go up, where we're being replaced by technology, where governments are massively in debt and we foot the bill via taxes, where we see debasement of assets so we can't afford as many assets as we like, so the rich get richer, the poor get poorer. If we don't like to see the rise of populism based on this broken society because the promises of the future have been broken, let's make our promises to our future selves come right. And that's by unfucking your future. Some of this is going to really fuck your future in 20 or 30 years' time, but we've got time to figure that out, because it's unstoppable.